What's going on? What's going on? What's going on, family? So, as you know, it's your boy Notorious CDG in the building, and today, what I really want to talk about and go over is how to utilize this powerful scanner called the harmonic scanner. It's a part of not only I Am Master Academy, it's also something I really try to instill into the CBC community and team as well, right? We're not only here to touch money from our laptops, from our phones, but we're also here to work smarter, not harder. So why not start utilizing a scanner that literally is up to 80% or minimum 80% accurate, depending on the signals, and which we're going to go over and cover today. So, with all that being said, as you guys can see here, this scanner is going to be called harmonic scanner, right? You're going to go to harmonics.im, and you're actually going to be able to access this as long as you have a current subscription to I Am Mastery Academy. If you don't, please comment in the description below, and one of our team members from CBC will actually go out and reach to you. So, with all that being said, let's get into the nitty gritty. First and foremost, right, you're going to see a whole bunch of mumbo jumbo here going on. So I actually want to go ahead down and break this to the most simplistic way possible so that anybody who has a MetaTrader 4, whether in IM or not, can really start understanding why this is so powerful and why they're so proficient into trading. So right here on the top right hand corner, you're actually going to see M15, M30, right? These are time frames. So this simply just means this is going to be on the 15-minute time frame, 30-minute time frame, H1, H4, 1 hour, 4 hours, or even the daily chart. Okay, so what that means is here on this little chart we see in front of us, we're actually going to see a whole bunch of candles. Now, depending on said time frame that we have selected on the top right hand corner, each candle is actually going to represent the selected time frame. So if I'm on the M30, right, 30-minute time frame, each candle is actually going to represent 30 minutes within the moving market. So now that we understand that, let's go ahead and get into even some more nitty-gritty details. Obviously, the higher time frame, that means the longer the trades very well may take, and the shorter the time frames, this actually might be depending on your strategy for some quick intraday traders to swing traders. Now, the 15, 30, 1 hour time frame does not mean that's how long your trades are going to take, because as you know, the markets move in a very fluctuated way. But this is an irrelevance time frame as to saying, okay, if we're on the 4 hour time frame, we're probably going to take longer to go from entry to take profit from the 15-minute time frame. Right, that's pretty self-explanatory. So, if we understand this to be true, let's actually go over what we will be trading in this market. So, what we see here are a whole bunch of currencies, right? Anything from the Australian dollar, AUD, versus the New Zealand dollar, right? The NZD, right? So we understand that to be true. We have the Australian dollar to New Zealand dollar, right? NZD, New Zealand dollar to CAD, right? Canadian dollar. GBP, Great British Pound to the Australian dollar, right? These are a whole bunch of foreign exchange currencies that we can now play and ride in the market, right, for potential gains. So let's say I was to go ahead and take a trade on the H1, right, the 1 hour time frame. I'm going to go ahead and scroll in a little bit. So you're actually going to be able to go ahead and see these little parameters that the scanner has set up for you already, right? We have entry right here. This is represented by this green line, and entry is going to be represented by 1.047. So what this means is you'll go on your broker, right? You'll go on your phone, and you'll actually type in whether it'll be a market execution depending on what price is. It will be a buy limit or sell limit depending on what kind of setup we're actually going to go ahead and take, right? So this is going to be the parameters I'll enter for my entry price. Now, I'm going to also set a parameter for my stop loss based on the scanner. Stop loss simply means this is a parameter in which we are going to stop the losses to our account, right? We're going to minimize as much damage as possible that can go ahead and be given or be taken away from our live account, right? Even a demo account doesn't matter, right? We want to get a feel for what's going to be happening in the market, right? So not only do we have a parameter for stop loss, right, to minimize these damages, but we also have parameters for take profits. Now, what this means is we are now setting parameters in the market saying, okay, when the value of said price rises from entry to parameter 1, parameter 2, or parameter 3, the market or our broker is actually going to go ahead and take us out the trade, securing the profits that we then gained from hitting said parameter. So if we enter, let's actually go ahead and let's look at this setup. Right, I'm going to actually use a tool called the long position, and we're going to see here. Okay, I know there's a lot of numbers, but this is the primary example we're going to use. Look at this where it says risk/reward ratio. We're at 3.57, so 3.5. People like to round up to 4. I'm a personally say 3 because I like to just cut it back a little bit, right? be connected to everything but attached to nothing. I'm not attached to the profits. I'm solely connected to the numbers, the percentage of what's going on in the market, right? So here you're going to see that this risk reward is a 3-to-1 setup, meaning that from entry to take profit 3, parameter 3, is 3 times greater than that I'm risking from entry to stop loss. Now this is a great and phenomenal ratio because this simply means if I take 3 trades with a 3-to-1 ratio and I go negative the first 2 trades, this is now going to be able to, sorry, my phone, someone's calling me on the phone. I am now going to be able to, on the 3rd trade, right, if I hit a ratio 1 to 3, I'm not going to not only get all my money back from the first 2 trades, but now I'm also going to be profitable on this 3rd trade as well, right? Because the ratio is 3 to 1. I cleared all 3 percentage, right? So the ratio was 3. So now I cleared the last 2 and onto the 3rd. So fire, right? I'm going to go ahead and delete this. Now let's get into this, right? Last thing I really want to point out the little details before I finish up this call is you have to see here on the price feed we have a different set of brokers, right? FX Choice, Hot Forex, Hugo's Way, JAFX, and Trader's Way. What these mean is these are all different brokers that you can go ahead and actually look to take plays from. Now, this has nothing to do with the currencies in terms of, which currency is better than others. This simply means depending on your broker, these trades are going to be a little more accurate to your broker due to something called spread. Spread is simply the fee that which the brokers take per trade. So if we're on Hot Forex, and let's just say, my broker is Prosperity. So for Hot Forex, right? The entry right here is going to be 1.04716. However, due to spread, right, Prosperity might be a little tighter, might be a little bigger. My entry may be 1.04, 13 or 710 or maybe even 720, right? There's just the minimal fee that really can make a big difference in your trading. So it's really good to understand where your broker is in spreads and how it compares to any set broker that we have here in front of us. Me personally, whenever I'm looking at trades in the harmonic scanner, or I really tell my team, we always go to Hugo's Way, that is the most closest to our broker. And I actually love to take trades anywhere from the 30-minute to the 4-hour time frame. So let's actually go ahead and we're gonna look at this play right here. Okay, awesome. Let me see if I can find a good setup, and we can go into the nitty-gritty. 1 second here, family. I'm gonna find here a good play for us to review and go over. Let's see. Okay. Okay. Let me just look at one more, and then we can go ahead. Not too hot. Don't stand too close. Not this way. Okay. Perfect. Now, one thing we really want to look for is, of course, was this harmonic scanner called out for us, right? Was this play called out perfectly? But also, let me see if I can zoom in here a little bit. Even though it shows, I don't care where I go unless I get paid. Okay, awesome. So one thing in the market we really need to truly see and understand is something called divergence. This is how we're going to go ahead and back test this harmonic scanner. Because although we were given entry 1 and 2, right, let's just say we didn't know any information based on this over here, right, where the blue is represented. I'll make this a little thicker. Awesome, right? Let's just say we didn't know any of this over here, and we only saw this uptrend going on over here. Well, some people may ask, well, which entry do we take, 1 or 2? And this is very simple, right? We have to understand what divergence is and then use it to our advantage. So divergence is simply the switch of trend before the switch of trend takes place. It's us being able to recognize that the switch of movement or momentum is going to happen before the candles can catch up to the switch of trend and then move in our direction, right? So over here, I really want you guys to notice this. Actually, let me see if I can. There we go. So let's notice this, guys. As you see here, let's go from this point to this point. We are clearly in an uptrend, right? We went from beginning point A and ran, or we call it C, right? We went from beginning point C and ran all the way to ending point D, right? So we clearly seen from here to here, we are in an uptrend. The price is moving up in momentum. Now, if we look at the given indicator right here called the RSI, this is called the Relative Strength Index indicator because it's going to show you within a certain frame, right, these dotted lines here, how strong is the momentum either going up or going down. Okay, so I really want you guys to notice this. So notice let me go ahead and pull this little tool out, the vertical. From our beginning point here, make this a little thicker. Nice, make this a little color as well. Awesome. And from end point here, look what happens in the corresponding movement in the market, or in the RSI, right? From here, we're going to go ahead and pretty much just flatline to downtrend in the market. Now, for those of you, and I'm actually going to delete this so we can see this a little clearer. For those of you who are looking and seeing this, right, you may say, well, okay, over down here on the bottom, it's flatlining, right? Maybe even, let me see if I can zoom in. Okay, it's flatlining, but also kind of going down at a cut angle. And, you know, for the sticklers who are like, oh, it's not the tippity top. All right, boom, right? Tippity top, and boom, it's still going down. It's still slightly at a disangled angle, right? Well, what is happening here? Simply, while the candles are on a clear uptrend, the RSI is telling us that, hey, momentum for the uptrend is dying down, and we're actually going to be looking to have a reversal point very, very close, right? So whenever I show my team this, I really tell them you have to understand where the momentum in the market is moving and how we can capitalize. Don't ever worry too much about entry. Really worry about, are we going to reverse at the D point and or near the D point? And you can look to find this by the divergence in the RSI and the candles as well. Okay, so now let's go ahead and we're going to take this play. I'm actually going to pull out a short position so we can go ahead and enter the market right at the D point. I'm going to go ahead, move my stop loss to the given stop loss that was told to us by the harmonic scanner. Let me bring this down a little bit. And I'm actually going to bring it all the way down to TP3. Now, see, why TP3 and why not 1 and 2? Well, it's very simple in all honesty. Boom, right? So let's look at this. A 5-to-1 risk reward, right? Actually, let me pull this out. Some of you guys may not understand. Style, it's compact bond. Okay, right. Risk to reward ratio, 5-to-1. Awesome. Now, some of you guys may be asking me, well, C's, why do you go for TP3 and not TP1 or 2? And it's actually, guys, it's very simple. Let me actually bring out a tool so we can represent this very well. And I'm going to put this tool here. Let's make this nice and thick so we can see this, right? Thick lives matter. We're going to make this orange. So on the broker, on MetaTrader 4, it's actually really awesome to trade because what happens here is our entry point is going to be right here at this D, right? At the D point here. And our stop loss is actually here, all the way on the top, right? Where stop loss is given at 1.19. Excuse me. So now that we see price starting to trickle down from entry, goes to TP1, right? Trickles, go to damn near to TP2. Let me see where it's at, right? Trickles, now goes to TP2. Well, now that we understand it, right? Price is moving again and again and again. Once it hits TP1, what I actually love to do is actually move my stop loss down to my entry was. Now making my trade completely risk-free. Let's just say that price, once it hit TP1, would have reversed and actually going to entry, then hitting stop loss. We now lost a winning trade, right? We should never lose a winning trade. If something goes off in our direction, we should then look to move our stop loss just above or below our entry, depending on what we're going for a buy or sell. And that way, if price comes back up to hit our entry, we would now just hit a break-even point, gaining nothing, but losing nothing as well, and that's really the most important part. It doesn't matter how much money we can make. All that matters is we're not losing anything, because what would you rather be? Would you rather always have a risky setup just to gain potential max dollar, or would you always want to have a risk-free setup to then see what the market will give you, right? Because you can't predict what's going on in the market. The scanner is only up to 80% accurate, and depending on the signals that we are given over here, the butterfly, the bat, the shark, right? These are all different patterns of harmonics. Depending on that, right, the range of accuracy can range from 80 to 90%. But at the end of the day, the markets do not owe us anything. So this is simply saying we can enter the market, but we have to be very, very careful. No matter how confident we are, right? Proper risk, understand our risk-reward ratio, and then count the pips so we know what's going on in the market. But now, obviously, there are other ways as well to really double and triple check, including institutional trading. But I really just wanted to go over it like this to make sure you guys got a clear and concise understanding what was happening here in the market. So, as you know, guys, please hit the like and subscription button below. It's your boy, Notorious CDG in the building, representing the CBC team and Academy Traders Unite. And you know, if you definitely want to get more access and knowledge on how to trade and also how to use this harmonic school, right, or harmonic scanner, right, work smarter, not harder. Don't be afraid to hit the comments below, and we will definitely reach out to you. Okay, peace.